In this week's video, we'll review present-day charts and data within the context of history to help us answer the question, does weak trend data mean lower lows are coming in stocks? The U.S. markets were weak on Monday, Tuesday, and Wednesday of this week. How much damage to the case that we covered last week? Specifically, the very rare move in the 7-week rate of change in the S&P 500. And you may remember in the previous 4 cases, good things happened walking forward. And last week, we purposely covered the maximum drawdown in each case. In the 1998 case, it was 4.29%, meaning after this, good things still happened. How does a present-day drawdown compare? Is it starting to put this analysis in serious doubt? Thus far, the answer is no. This is 4.29%. What we've seen on a closing basis so far is 4.05%. Also from last week's video, and in all of the historical cases, good things happen for a long period of time. Our 4.05% drawdown thus far not really out of line with what we covered last week from a realistic expectations perspective. If we greatly exceed this figure and greatly exceed this figure in the coming weeks, it simply speaks to probabilities. Back to the question and concern about weak trends. In recent weeks, we have shown that something that just happened in 2020 was similar to 1975, 1998, 2009. And this study tied the present day to 2003, 2009, 2011, and 2019. Similar situation here, something that just happened in the present day, similar to 02, 09, 11, 16, and 19, covered in the April 17th video. In these cases, good things happen between 6 and 5 years from the date of the signal. Also covered recently, this chart dated April 29th, tied the present day to January of 1988 after the 1987 low, in April of 2009. And as we've shown numerous times in recent weeks, all of that tells us to keep an open mind about better than expected outcomes walking forward. As we cover the charts in this week's video, you will see that it is still prudent to keep an open mind and be prepared for a wide range of outcomes. Being prepared for a wide range of outcomes does not mean you're sitting around waiting in 100% cash. It simply means you have contingency plans in place. If you're a long-term trend follower and you see numbers like this, and you see a study like this, or a study like this, you might say, that's great, Chris, but the trends are way too weak for something like that to happen. We'll be the first ones to admit that the longer-term trend data is on the concerning list. There's a difference between concerning and being a showstopper. Clients and regular viewers may remember we used bull-bear roadmaps the first week of January 2019 after the Christmas Eve low 2018 to help us assess probabilities walking forward. Now we'll use the exact same generic moving averages between the 50-day and the 200-day. This is the present-day chart this week. These moving averages on a daily chart, this is 52 calendar days after the March 23rd low. Price, for the most part, is below all of the moving averages, and for the most part, the slopes are down. How concerning is this from a trend perspective in terms of keeping an open mind about better than expected outcomes? To help us answer that question with facts rather than fear, after the low in 1974, 1987, 1998, 2009, 2011, and 2018, all periods that we have tied to the present day with facts that we have in hand in 2020 in recent weeks. How does the look of this chart compare 52 days after the low in each period? Better, worse, or about the same? If you're a long-term trend follower, fair to say, 52 calendar days after the major low in 1974, this is a weaker trend look relative to 52 days after the low in 2020. 52 days after the low in 1987, not particularly encouraging here relative to this chart here. 1998 looks a little bit better, but still not great. This is not materially different from this look here. Cluster here, white space, 50-day. Cluster here, white space, 50-day. 52 days after the low, price for the most part below all the moving averages, and the slopes are down. Basically the same situation here. 2002, worse. 2009, worse than the present day. 2011, probably a little bit better. 2018, probably a little bit better, but not materially different. Notice the 50-day in every single case looks similar, 50-day in blue. Since these charts are somewhat subjective, our trend strength model, which is a sub-model in the CCM market model, is objective. The long-term trend score in the present day, 52 days after the low, is almost identical to the long-term trend scores in each one of these cases. And the trend score for all of the time frames that we use, which tend to be longer term, very, very similar to these periods here. Well within striking distance. Net bottom line, the look of this chart and the trends from a long-term perspective, not materially different than 52 days after the low in each one of these cases. Is it a concern? A little bit. Can it be addressed relatively easily with a look like this mathematically? Absolutely, positively, yes. And it's possible that the way it is addressed is through consolidation. Consolidation or some type of sideways movement. We'll be able to use these charts going forward to see if they look like these cases. For example, if we take these charts here, which are all 52 calendar days after a major low that we've already proven in recent weeks shares similar characteristics to what we've seen off of this low in 2020. How did these charts evolve, let's say, between May and year end in each one of these cases? Here's the answer to that question. If we walked forward between May 14th, 2020, or 52 calendar days after the recent low, 231 calendar days, that would take us to 12/31/2020. What was the additional gain between day 52 and 231 in each of these similar historical cases? 37%, 6%, 20%, 25%, 15%, and 6%. Average gain over the next 231 calendar days, 16.63%. Median gain just under 15%. Simply telling us to keep an open mind about better than expected outcomes walking forward. It also gives us somewhat of an expectation of what to look for walking forward. How about from a longer term perspective? This is the look of this chart, 52 calendar days after the low, similar to the look in the present day. How did the stock market do from 52 days after the low to the next major peak in each case? Keep in mind, when we're walking forward, this is a very weak long-term trend profile. This is a weak long-term trend profile. Not all that encouraging here either. Same can be said for this chart here. From this point here to the next major peak, the S&P 500 gained an additional 56.50%. That's walking forward from day 52. 45%, 41%, 40%, 83%, and 23%. Average 51.06, median just under 46%, telling us that a relatively weak long-term trend look, a relatively weak long-term trend look, a relatively weak long-term trend look, not that materially different from what we have on May 14th, 2020, is not a showstopper between now and year end, and is not necessarily a showstopper for much better than expected outcomes walking forward. Outcomes that would align with the studies that we've done in recent weeks, and the tables that we've been covering in recent weeks. Net bottom line, weak trend data is a concern. It's not a showstopper. We'll learn something either way, and that's the purpose of covering these charts. You may be saying, with the economic data that we have today, there's no possible way something like this could happen. Tweet Friday morning, Twitter handle where my cursor is. Capacity utilization at a record low, never been lower. Could have said something very, very similar right here. Notice that happens at the end of the recession. Something very, very similar right here happens at the end of the recession, the shaded area. Right here, end of the recession. End of the recession, record low here, right near the end of the recession. How is it possible that this line would move in this direction? I wouldn't say it's possible. I would say it's highly likely. If we open up the economy and people are returning to work in any shape, form, or fashion, capacity utilization should bounce back. And in each case, when it bounced back, the recession was over for the most part. Not a prediction, simply telling us to keep an open mind about better than expected outcomes and a relatively short recession in terms of the duration. The magnitude is obviously very, very serious. When we've said in recent weeks that the bearish case is easy to understand, that's our way of saying we have data in hand that's concerning. We just showed you some of it. Remember a few weeks ago we said central banks in the group of 7 countries purchased $1.4 trillion of financial assets in March, nearly 5 times as much as the previous monthly record set in April of 2009. Previous record, we have shattered it. 2009 case, notice before the low, yields start to rise. We have a bond market that's still skeptical in the present day. One theory that we've had in-house for weeks is that this amount of stimulus could have possibly skewed the markets in a serious way. There's no question it's a big part of the move. But remember, a few weeks ago, we said often we get double spikes near lows. If you look real closely here, there's a spike right here and then a second spike. 2009, there's a spike here, and then a second spike, and actually a third spike. The 7-week rate of change says this spike here is similar to this spike here, which is what we covered last week. Here's your rate of change in 2009. A1 is similar to the 7-week rate of change, A2, in the present day. This one's roughly 27%. Left side of the screen, this one, 27%, right side of the screen. But what happens if that's really been skewed in a big way by the Fed, and that this spike here is really the first of 2 spikes? Meaning, instead of April 24th, 2009 looking like May 8th of 2020, what happens if this spike here is similar to this spike here, but this one has just been skewed by the enormous, can't overstate amount of stimulus that's been put into the economy globally by central banks? If we look like this period here, then A2 on May 14th, 2020 could be similar to January 6th of 2009. The only difference is this is a much bigger Fed-induced spike. In this case, after the first spike, bad things happened in the stock market. From January 6, 2009 to March 9th of 2009, the S&P 500 lost 27.62%. If this spike is a Fed-induced false rally, too early spike similar to this, it says we have to be open to a much lower low. We really don't have a lot of data to back that up. You can review last week's video. We covered a lot of data that said we probably look like the period after the low instead of before the low. But it's possible all of that has been skewed by the Fed. It simply helps us keep an open mind. It's not a bearish forecast. It's healthy from a flexibility perspective and a contingency planning perspective to respect much worse than expected outcomes along with much better than expected outcomes. From this point forward, we're going to be moving at breakneck speed. Why? Because we've covered many of these charts in the past and many of them are still indecisive. We're using them to know what to look for walking forward. Leverage loans still holding above the 61.8%. That's a good sign. The Nasdaq has already cleared this area of congestion. That may foreshadow what's going to happen in the S&P 500. If not, if the S&P 500 fails in the present day near similar congestion from 2019 and 2018, this may act as support in the Nasdaq. Nasdaq still holding above the 61.8, still holding above this trend line. Won't spend a lot of time on this. This basically shows Nasdaq weekly. When weekly RSI gets down to the blue line and then fights its way back to the thin blue line, in each one of these cases, the low was already in. However, you can see in this case, there's some volatility after that point. In this case, in the general region, volatility. In this case, some volatility here. Speaks to a bottoming process and probabilities relative to, is the low in or are we going to make a lower low? One word for this chart, indecisive. We'll learn something either way walking forward. Energy index, natural gas and oil. This is Thursday. Friday it was up. This leans favorably. This almost looks like a failed bearish breakdown. Dow still holding as of Friday's close above the 38.2 in this area. Thursday's session, you can pause your video player. Regional banks, this is big volume. Double average volume. Thursday's session. This is not necessarily bullish. Doesn't mean you want to buy this. It means you want to pay closer attention. Why? Because others are paying closer attention. Typically speaks to large institutions. KBE. This chart has a lot of work to do. We really want to get up into this area here and hold it. Not there yet. Like the global Dow, indecisive. Semiconductors stalled in this general area. This theme will carry forward. Look how long it took to break through this area. We may be looking at a period of consolidation in the present day. You have to make sure you don't whipsaw yourself into oblivion. High beta versus low beta. We'll learn something in this area here. Industrials have not cleared this area here. They have work to do. Many of these indecisive charts help you understand the bottoming process or lower low scenarios from a probability perspective. Friday, May 15th, 1:44 p.m. Good news, still above an upward sloping 200 week. That's not really what a devastating bear market looks like. Bad news, we were down this week, but not much has really changed. We've been hanging around in this general area for several weeks. What's one of the ways to deal with this issue here relative to weak trends? Answer, consolidation. Again, we have to make sure if we go sideways for a while within a wide range that we don't whipsaw ourselves to death by overtrading. That's why something like this is important. We have to understand that an 8% drawdown would not be shocking. And after this 8% drawdown, really good things happen walking forward, as in a 70% gain looking out 5 years. Volume by price, possible support in this area here and this area here. Possible resistance at this level here. This is Friday, 3:09 p.m., May 15th. The S&P 500 is holding above the 50% retracement. It's hard to get too negative with this look here. That's not a prediction about what's going to happen next week. That's a statement about what this chart looks like today. You can pause your video player. We covered all of this last week. Walking forward, this week is similar to April 30th of 2009. April 30th of 2009 relative to the low. This is the lowest the VIX got. We're in better shape in the present day. We've gone lower than that. We haven't seen anything like this type of concerning spike here yet. What we don't want to see is a big 2 to 3 day rate of change in the VIX. We've seen a little of that lately, telling us to pay closer attention. Gold miners GDX, long-term multiple-year breakout still holding, constructive at this point. Breakouts sometimes have retests. Gold miners relative to the S&P 500, GDX relative to SPY monthly, 2008 back here. Step 1, you break a trend line. Step 2, you make a higher low relative to this low. And step 3, higher highs. We have that. Simply speaks to probabilities. MACD trying to get above 0, telling us that the primary trend is trying to shift from down to up in favor of gold miners. That doesn't necessarily mean you would be down on SPY. That is a relative trend. They can both go up. This speaks to relative performance. Now we're looking at GLD, physical gold ETF relative to SPY, still holding this breakout. This speaks about the market's inability to broaden out. This is a bullish breakout for the equal weight S&P 500 ETF. This is a failed breakout and then a lower low. If you are a stock market bull, you would prefer to see this chart get into this area and go in this direction. If you are a bear, you want this chart to look like this. We don't care about being a bull or a bear. We care about getting it right. This chart can help us do that if we have an open mind. Home builders have done a much better job holding that breakout. I might add, economically sensitive home builders relative to SPY. Small caps trying to make a turn. Look at all of the interest from a volume perspective since this low. It's not a buy signal, it's a pay attention and be open to owning or adding to what you already own signal. This one's a mixed bag. Breakout, failed breakout, but sometimes retests look like failed breakouts. This one's treading water. If we can get up here, that would be better for small caps. This is another chart that's treading water. This is somewhat of a form of credit spreads. Equal weight tech versus IEF. We'll learn something based on what happens in the coming weeks. Still holding the breakout that we covered last week. Broad market ETF SCHB relative to SPY. This one is holding the breakout thus far. This does speak to a market that's trying to broaden out. Still has work to do. Hard to make an argument that this is a bearish looking chart. This is growth stocks relative to defensive TLT. You can make an argument that this is an inverse head and shoulders like pattern. This is your neckline, and this is a bullish breakout that is holding as of 2:04 p.m. on Friday, May 15th. If the world was going to end economically, I really don't think this chart would look like this. If the world is going to end economically, it won't stay like this. Here's another one, indecisive. This is a radar chart to help us assess probabilities. Everything that we just said about the last chart applies to this chart. This chart tells us to keep an open mind about a retest and or lower low type scenarios. This chart is one of the reasons why we have positions in gold-related ETFs. And this look here tells us to keep an open mind about a failed breakdown and a move back in this direction. This is bonds during Thursday's session TLT. Bonds were down on Friday. I believe we covered this chart last week. Big spike up, then you make it back down here. Big spike up, then you make it back down here. Notice this is before the final low, a few weeks before. Notice this volatility in here in this ratio. Tells us that we could see some volatility in this ratio here, but eventually the ratio dropped. Bullish doesn't mean straight up. Bearish would be holding and seeing this ratio go on to make a higher high. We own bonds, so we're not rooting for either outcome here. We just want to get it right. If you're experienced in the markets, you know one of the basic axioms is cut your underperforming positions and add to your winners. We added some VTV in this area here. Nothing crazy, a very small position. Not working out particularly well versus SPY. We've already reduced it. Happy to add to it if it can move in this direction. If this is the look of this chart versus SPY, I can guarantee you it looks worse relative to growth stocks. If the world was about to end and lower lows were coming, would this chart really look like this? Not a forecast about what it looks like in the coming weeks. It's just a statement about what it looks like on May 15th at 2:08 p.m. Eastern. This is kind of a mixed bag chart where we'll learn something, but the slope is up. Economically sensitive retail Friday, after a horrible retail sales report, outperformed SPY as of 2:15 p.m. by 2.21%. This breakout here, left shoulder, head, right shoulder, thus far is holding above the neckline. That's the good news. The bad news is you've still got some work to do relative to a trend line that we could draw here. This is a good step for XRT. We'd like to see the next step occur out here. If you're looking for a reason to keep an open mind about worse than expected outcomes, here you go. If you're looking to keep an open mind about adding to your financials or owning them in the future, here you go. Right here we held, it's possible that we'll come down to this trend channel here and move in this direction. Notice we said possible. Not surprising that this chart looks like this when you shut all the factories down. When we reopen them, we would like to see it move in this direction. This is definitely on the concerning list. Look at this big bounce here and then this move here. Is this possible? From an economic perspective, if you pause your video player, history says we should keep an open mind. Pause your video player, exact same thing here. Stock market's way out of line with the economy. History says that happens a lot. Thus far, based on market action in the charts that we've covered, we have not seen anything, including the drawdown that we experienced this week, that has discounted this analysis based on this chart, nor countless studies that we've covered in recent weeks. A chart like this, still relatively weak trend data, and the possibility that the Fed has skewed the market in a bigger way than they've ever skewed it before, makes it very, very easy to keep an open mind about all four scenarios. There's two basic ways to use charts. You can use them to try to predict, or you can use them to assess probabilities. Ask yourself, how accurate have all the predictions been in recent weeks relative to the stock market? Now you understand why experienced investors use charts to monitor and adjust rather than forecast, and to assess probabilities related to numerous outcomes, and using those probabilities to build contingency plans. We've already assessed these probabilities, and they're already reflected in our current allocation. We'll do the same thing next week as we did this week. Does our current allocation align with the facts that we have in hand, or do we need to make some incremental adjustments? And we all know the only way that we can do that effectively and use these charts effectively and use the data effectively is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.